Hi, everyone. Thanks so much for having me. I'm Mariam Farbudi. I'm the John D. Gruber Career Development Professor of Finance at MIT Sloan, and I'm really happy to deliver the closing remarks of 11th staff meeting. I will be talking about the big data revolution in finance. We live in the midst of the big data revolution, where data is proving to be the new capital. We all care about this because data is a new asset class. Data refers to many things. However, data that underlies the big data revolution, which is really what is feeding into the AI and machine learning algorithms, is the data that is used for prediction. Investors can use data to predict firm performance and market demand, and companies can use customer data to improve the quality of their products and services. In either case, in finance, collection, processing, and use of data has exploded. We would like to understand which assets and prices are most affected and how to quantify this data and its value. Many companies are increasingly using data, and this data mainly comes from customer transactions. You should also understand what the companies use this data for to be able to assess the privacy concerns of customers and the regulation that is intended to address that. Furthermore, we are hoping to design and regulate financial data markets effectively. For that, too, we need to understand, quantify financial and customer transaction data and value it. Let me start by showing you a graph of growth of data processing. In this graph, you can see the growth in processor performance compared to a benchmark from 1978 to 2006. In the first decade, the processing performance has been growing at 25% per year. However, since then, for a few consecutive decades, the growth has increased twofold. The processing power has been growing 50% per year. And that's what underlies the big data revolution. This revolution has been identified by industry and by the media way before it became the center of attention in academia. Here you see a picture of the Economist cover in 2017, 5 years ago, which puts data as the world's most valuable resource. And inside the same issue, you can see the new oil companies of today's world: Google, Amazon, Tesla, and Microsoft. This really signifies how models of manufacturing and producing tangible goods are less and less relevant for the modern economy. However, our understanding of the economics of big data still lags behind. And the reason is that data is very difficult to incorporate into our models. Data is unobservable. We don't have great models to systematically disentangle data functions, and data valuation are difficult to measure and quantify. And these are what I would like to focus on in this talk. In order to think about this issue, I'm going to use a framework in which data is used for prediction. The framework is ultra simple. There's a continuum of agents who want to make a decision under uncertainty. And as we all are very well aware of, in financial sector, uncertainty creates risk. Risk can be the risk of profit loss, such as producing undesirable products or taking wrong financial positions. It can be also risk of death and injury because, for instance, we introduce a drug into markets that there's not enough data about it, or self-driving car that is not sufficiently tested with data. Now, instead, if you have the data reduces the uncertainty and enable agents to make better decisions. That can increase profits and can improve welfare. So we want to understand what we should expect as data availability and technology of data collection and processing improves. It improves in the financial market, while firms are using consumer data, as well as a lot of data markets emerge. So let me try to pinpoint a little bit, what is the data that I'm talking about? This is data that is used for prediction, and it's used either by investors or by the companies. Investors use data to predict firm fundamentals or market sentiments and demand. So they want to understand what other market participants are doing. Companies, on the other hand, use customer data to find what is their best production quality and what is the customer taste that they like to cater to. This data comes from maybe investor information acquisition, it can come from firm performance history, or it can come from customer transactions. This framework really relies on one basic tool, which is the Bayes law. Bayes law is really the bread and butter in economics of prediction. Bayes law just tells you that if you would like to predict some random outcome and you have some prior knowledge, you have acquired some information, or you have produced or you have had a lot of transactions with customers, which all gave you data, this more data really improves the precision of your posterior belief about what you like to predict. So Bayes' law just tells you that the posterior precision is additive. The more data that you have, the better that you can predict what you're interested in. With that, let me provide you with a number of conceptual insights from my research, and then delve deeper into measurements of data and data value. And I would like to end with what I think is a really fruitful idea that financial industry and academics can join forces on and improve our understanding. Let's first think about what the growth of data technology in the financial markets mean as a whole. Growth theory describes how technology boosts efficiency. However, in finance, technology in the form of IT is blamed for volatility, illiquidity, and inefficiency. And the concern is that big data is changing not only how much data we use, but also what kind of data we choose to use. We can use big data to predict asset payoffs, or we can use it to predict market demand, what other investors are doing. So what you find is that there are different phases of data analysis. When information technology is poor and there's very little data, investors mostly focus on fundamental analysis. Then there is a huge rise in statistical or demand or sentiment analysis. And once data becomes very, very abundant and technology becomes very, very good, then both types of data analysis grow together. Moreover, price informativeness of implied that is implied by this data grows monotonically through time. However, markets first become illiquid before reverting and becoming more liquid. These findings you can all see in the following two figures. In both figure x-axis is time. In the first figure on the y-axis, you see the amount of data that is analyzed. The red curve is the fundamental data, and the blue curve is the statistical or demand data analysis. This little square in the middle shows you what happens in the very short run or in the medium run. Very early on, when technology to process data is very poor and very little data is available, for investors choose to learn more about firm fundamentals. They want to do more fundamental analysis. That is what happened 40, 50 years ago. Then in the medium run, where we are right now, there's going to be a huge surge in demand or statistical analysis. So you can see that statistical analysis takes over before getting to a very long run when both fundamental and statistical analysis grow together. While this thing is happening, although the type of data that is analyzed changes, you can see that prices become informative monotonically. So price informativeness gets better and better, although investors choose to learn different types of data. However, market illiquidity, which is in the blue curve, first gets worse. It becomes really, really bad before going down and markets becoming very, very liquid. Now, these are aggregate trends. However, we know that there is a huge degree of heterogeneity in the cross-section of firms. Although it is true that, for instance, in the US financial markets, S&P 500 price informativeness has improved over time. But if you take just an average of price informativeness of all the public firms listed in CompuStat, that has actually deteriorated. So that raises the question of whether all the firms have benefited the same amount from the technological progress in data processing. What we do find is that the answer is no. There is a huge divergence in data and information efficiency of prices. Most of data processing by investors is actually about large growth firms. And the reason is that investors process the data that is most valuable to them. And stock size, as well as growth prospects of a stock, interacts to make data about a particular stock more valuable. And that is why it's really the price informativeness of large growth firms that has improved over time. These findings leads us to ways of measuring investor data that I will allude to later. There's also spillover from the financial markets to the firm distribution. In particular, we have observed in the US that in the past couple of decades, small firms are being displaced by larger ones. An important reason for that is the big data revolution, because it benefits growth of large firms disproportionately. Why? Because data comes from economic transactions. Big firms that have a lot of transactions, they produce a lot of data, and investors can process that. And that reduces the risk of these firms and it means that the cost of capital for large firms drops disproportionately. So the key mechanism is that data resolves risk. Lower risk reduces the risk premium, which in turn reduces the cost of capital of large firms. So the large firms can grow even larger. Now that takes me to what is a key point of this forum, and that is how firms use customer data. Note that a key theme in this whole talk has been that the data is a byproduct of economic transactions. So firms use data that they get from transacting with their customers to predict customer taste and improve the quality of products and goods and services that they provide for the customer. So they use the data to predict what is it that the customers want. What is really important to notice is that data is non-exclusive. So depending on the type of regulation that is in place, firms can sell the data and still use some of it. And that is a key difference with other factors of production. For instance, labor and capital are exclusive. I either work at MIT or at Harvard. However, the same data can be used by both Harvard and MIT to understand what is it that improves the life of students. Furthermore, data is tradable among firms. It's very different from learning by doing or job training, which is really tied to the labor, and it cannot be traded separately than the labor. So firms can use the data that comes from their customer transactions to produce high quality goods and services, and or sell it and make profits from data sales. This implies that the long run and short run trends of firm growth has a very specific form. In particular, whether data can sustain long run growth or not depends on the data usage. Whether data is used for process optimization, such as product personalization, advertisement, management efficiency, hiring and firing, labor force management, or reduction of search costs, or it's for innovation. Think about innovation as self-driving cars. If data is used for process optimization, then although in the long run it cannot sustain growth, but in the short run, data has increasing return to scale. And that is the familiar data feedback loop. So if a firm produces more data, that means that the firm can improve its quality. If it improves its quality, it can have more consumer transactions. More consumer transactions lead to more data, better quality, more customer transactions. So data really feeds back on itself. What's also important is that this increasing return to scale in the short run can lead to data barter. And data barter is what we see every day in our lives. So we all have free apps on our cell phones. Why is it that the developers of these apps allow us customers to use their apps for free? Because then they can collect our data and use this data to improve the quality of the app, and then going forward and sell the app to the customers for some positive price. And that is data barter. Data barter is a byproduct of data feedback loop. This also gives rise to the data markets. Because data is not exclusive, if there are no friction in place, data markets should be active among firms, and companies should voluntarily participate on the data market and sell the data that they collect from their customer transactions to other firms or other companies who can better use this data. Policy also encourages data sharing, and that's very well seen in open banking policy, which is now being heavily implemented both in Europe and in Southeast Asia. And in open banking regulation, government would like to encourage large banks to share the data of their customers if the customer wants the fintech industry to improve the entry of fintech firms. Data markets also imply that data intermediaries emerge, and these are firms who have a superior ability or technology to process data. They're going to be larger, and they're going to specialize in data markets and sell data packages to their customer firms instead of actually producing high quality goods. Furthermore, as I alluded to, new entrant firms, such as fintech firms, rely heavily on data markets to facilitate growth. These firms don't have a lot of transactions, so they need to buy customer data from the larger firms who have a lot of customer data, and these fintech firms will use this customer data, will build on it to improve the quality of their products until they start growing and producing data on themselves. However, this raises all sorts of customer data privacy concerns. Customers might not be willing to provide their data to a wide range of firms, or they might want to be compensated for sharing their data. They might also be worried that the firms are going to use their data to price discriminate against them, and that understanding these concerns helps us understand the regulation that is trying to address customer privacy. Finally, a data market leads to emergence of the data monopolists, because firms might not want to share their data with their competitors because they're worried that they're going to lose their comparative advantage from having a lot of data. And this leads me very nicely to talk about measurements of data and its value. In order to measure investor data, we're going to use data from a US stock market. We're going to divide firms into 4 groups based on whether they're small or large, and whether they're growth or value firm. So we're going to have 4 firm groups: small growth, large growth, small value, and large value. You can decompose the price informativeness of each group of stock into 3 components. The first component of price informativeness is stock price volatility. The second component relates to firm growth prospects. And the third component is about it's about investor data that is built into price informativeness of the firms. What we do is that we're going to measure price informativeness, volatility, and growth of each stock group through 6 different decades. And from that, we're going to back out how much data is embedded in their prices. Price informativeness is very easy to measure. What does price informativeness mean? It means how much a stock price tells the investors about its future profitability. So we just simply regress the asset-weighted EBIT, earnings of the firm, on their past market price, and that gives us the price informativeness. Now, what we're going to do is that what I want to do is I want to plot the trends of price informativeness and investor data for these 4 different groups of firms over time. And that is what you see here. In the left graph, you see the evolution of stock price informativeness from 1960 to 2010, and on the right, the evolution of investor data. And you can see that there are 4 lines in each graph, and each line corresponds to a particular group of stock. For instance, the orange line in both plots correspond to the large, high growth firms. What is very evident from these figures is that both price informativeness and investor data is heavily rising only for large growth firms, while the price informativeness and amount of data for the rest of the firms is at best stagnating. So there is a huge divergence in the financial data that investors produce about different groups of stocks. And that raises the question of why. And that is a difficult question to answer because the value of data to investors is very, very heterogeneous. It depends on investor characteristics such as their wealth and their investment style, as well as stock characteristics, and importantly, on market conditions, how liquid markets are. And that leads us to take a simple statistical approach. You can write the utility of investors from having a particular data about a particular group of stocks. And this utility can be decomposed into three pieces. The first piece is what we are all very familiar with. It's the Sharpe ratio of the stock. So as an investor, you would like to take a position on a stock which gives you a higher Sharpe ratio, a higher risk-adjusted return. Furthermore, as an investor, you would like to take a larger position on stock where its variance is reduced from data. So remember, what data does is that it reduces uncertainty and risk, and that encourages you to take a larger position on stocks that have lower variance. Finally, the last component of investor utility depends on their wealth and their risk aversion. Now, what's most interesting is that you can convert the investor utility of data to their dollar value of data by just calculating how much money they're willing to take in exchange for this data. So when are they indifferent between not having the data and instead having the risk-free wealth compared to having the data instead? So with the statistical framework, we can go and measure value of financial data. This table shows you our estimates of value of financial data in thousands of dollars. And it shows you that it's affected by three margins: by investor wealth, by investment style, and by market liquidity. So you can see that there are two panels. In panel A, I assume that the markets are perfectly competitive. There is no price impact. While in panel B, there is price impact. Then let's focus on panel A. Each row is an investor size. The first row is a small investor. It's an investment firm which only has 500K assets under management, while the second row is a large firm which has 250 million wealth. Each column is an investment style. Think about a mutual fund or an ETF which targets a particular group of stocks: small stock, large stock, growth stock, value stock, or S&P 500, or alternatively, an investor who can invest in all of these groups of firms. So the first thing that you can see, just focusing on the first panel, which is perfect competition, is that a large investor, a wealthier investor, values data more than a smaller investor by orders of magnitude. Why? Because they can take larger positions. Second, you can see that across different portfolio types, investment strategies, it's really investors who invest in large stock and in growth stocks who value data the most. Finally, comparing the panel A and panel B, what you can see is that market illiquidity, which means price impact, very much reduces the value of data to investors. And in particular, it reduces the value of data to large investors. And the reason is very intuitive. Investors like data to guide them to take a position in more profitable stock. If there is a lot of price impact, the large positions that they take moves the prices against them, so they cannot use data as effectively. So the highest use of data is when markets are liquid. Okay, so that takes me into really the last part of my talk, in which I want to step forward and an area that I think there is a lot of room for collaborations between people in academia, researchers like me, and people, leading industry managers like you guys, who know a lot about how consumer data is actually used in the industry. To see that, let's look at data as a traded product. Market for data is on the rise, and regulation is also on the rise. Data intermediaries have emerged who sell, and data brokers sell customer data to firms. And you would like to understand value of customer data to firms. So I would like to really encourage all of you industry leaders to, if you're interested, please reach out to me, and we would love to collaborate with you guys and take advantage of the amazing data that you have, and we're more than happy to share our findings with you. And that is the same for digital intermediaries who share digital services with customers. So let me end on the note that technology is transforming markets, and we need theory and measurement to make sense of this constantly evolving landscape, because there's been numerous shifts in financial and real sector that are a logical consequence of improvement in data processing. Data is changing how firms operate. So data is the new oil. However, we have very, very little information about how financial firms are actually using the customer data. We would love to know where they get their data from, what they use their data for. So if you want the quantity of the data that they trade, the price of data that they trade their data at, and how they use their data, their customer data that they acquire to improve their products. That would really help us generate insights about the consumer privacy concerns and how firms can go around them and can capture consumer data and use it without violating these privacy concerns. That would also help us measure the data and the value of data to customers and to companies. If data is extremely valuable to companies, which I think it is valuable to, if necessary, even compensate customers for the data that they're willing to share, because having a lot of data really gives a comparative advantage to the firms in order to improve their products and their strategies. Think about simple financial services that are provided to customers. If you know what services or what customers really want, you as a firm are really able to better provide these services. So the value of the state customer data to you as firms is really, really high. However, customers are concerned with their privacy as well as price discrimination. So understanding the value of data to companies and to customers is really critical to enabling this data trade. Thanks so much for having me.